Hi, I'm Lynch, Head of Market Insight at EquityZen.
Hey, my name's Phil Haslett. I'm the co-founder at EquityZen.
Excited to be here with Phil today to talk about a topic that's near and dear to our hearts.
Today's episode, we're going to cover a little bit about what it means to be an employee of a company when you're looking for liquidity, and what it means to be the company itself when thinking about liquidity needs for your shareholders.
So, Phil, I know we deal with the secondary markets day in and day out, but I'm sure there's plenty of people who don't, who are listening and really curious to just kind of better understand what this market is and frame it a bit. Phil, can you give us a little bit of a tutorial or one-on-one on that?
Yeah, sure. So really, secondary markets are a marketplace, so you've got two sides involved. So I like to think of it really as the most fundamental need in a marketplace for both sides, right? So on the one hand, you've got employees, ex-employees at these private tech companies that got issued stock options or shares, and the company's private, right? So they can't just go into their brokerage account and get liquidity for them. So they're looking for a way to monetize these shares. Could be for down payment on a house, could be for just diversification, and they don't really know where to go. So we serve as a place for them to get liquidity. And the other side, you've got a bunch of investors that are tracking really cool technology that's out there that they want to invest in, like they would have invested in DocuSign 10 years ago or IBM however long ago. And when they go into their brokerage account, they try to search for these companies. They can't find them, so they end up kind of ending up on EquityZen or kind of in these markets looking to buy these shares. So really kind of just connecting unmet needs on both sides. That's what marketplaces do. And then probably the important thing to cover is that each of these transactions is in a private company. And so you kind of have a three-legged marketplace because you've got the companies that need to approve each of these transactions. So kind of working with them as well.
So I know EquityZen's been in this market for about 11 years now. When did this market really start to percolate? And, were there drivers that, drove both EquityZen into the market, but then just broader market activity? What were kind of some of those inflection points?
Yeah, so I'll give the kind of nerdy answer first, and then I'll give kind of what really happened second, but they kind of come together. So the first nerdy part is that in the early 2000s, there was a bunch of companies that were public that ended up completely blowing up, right? So you can think of like Enron as probably the best example. And as a result, the SEC made it a lot harder for companies to file to become public because they wanted to more heavily scrutinize the company's books, accounting, financials, et cetera, right? And a negative externality of that was a bunch of smaller companies decided, well, instead of me going public, I'm just going to stay private longer, right? Because it's just so expensive and it's so onerous to be a public company, even though my books are fine, right? It's going to take me so much time. So as a result, you had companies that decided to basically stay private longer and raise money in the private markets. The less nerdy answer is this really started with Facebook, Twitter, LinkedIn. They were kind of like these OG, like large privately held companies. Facebook, I think, was an $80 billion valuation at the time it went public. So in the early 2010s, I think I have that right. Yeah, 2010, 11, 12, a bunch of Facebook employees started wondering what they could do with their shares. Some enterprising person out there said, I think I could help you, connected them with investors that wanted to buy, and that kind of kicked things off. So that was kind of 2010 through 2012. And then since then, companies have stayed private longer. One, because of the thing I just mentioned, it's really expensive to file to be a public company. And the other thing that happened was investors got way more comfortable giving a lot of cash to these private companies, right? We talk about zero interest rate environment and the growth of private markets. It was the growth of private capital, right? A VC investor used to have a $300 million fund. Now they got $3 billion fund. You've got Fidelity that used to only invest in IPOs. Now they're willing to give a $200 million check to a private company. So that really proliferated kind of the growth of this space since the start. So after Facebook goes public, there's now this awareness, kind of, right, a little bit, that people could have bought and sold shares of Facebook while it was private, right? And that was like a completely like mind-blowing idea at the time, right? Most people thought it was illegal or that you didn't know how it worked. And so as a consequence of Facebook, prospectively, any other private company that was starting to get large, call it $1 billion, $2 billion, $10 billion in valuation, you started to have investors looking to invest in the company, and you started to have shareholders, mainly like these employees, looking to get liquidity for those shares. And when you have a bunch of people that want to buy something and a bunch of people that want to sell something, a marketplace tends to develop. And we were very, very fortunate on the timing. I would give ourselves like a little pat on the back, but generally very, very fortunate on the timing we had, that those things all came together at the same time, 2013, 2014, 2015. All right. So Bree, probably an important aspect of this is the employees. They've got equity or stock options in these companies. You've worked with a lot of them. You've also built a lot of, the user experience for EquityZen on helping with these shareholders. Maybe tell us a bit more about what their experience is, why they come here, what's important for them.
Sure. So what we've seen as companies continue to stay private longer is that there's just so much more of a need for liquidity amongst early employees. So they could be former employees, they could be existing employees, but they have this liquidity need, especially over the past 2 years. So maybe their company said in 2019 or 2020, we're going public in the next 6 months. As the markets cooled, that those plans were largely put on hold. We've seen that there haven't been many IPOs in the past 2 years. So a lot of these employees have been left waiting. And some of these very early employees have stock options that are expiring. So they can't afford to exercise those options and have options expiring, but there's no, pathway in the near term to liquidity. They're kind of in a bind. So we've talked to a lot of employees who that's their issue, and they're trying to figure out how do they both sell and also exercise their options at the same time. So that's one piece of the puzzle. But I would say more broadly, beyond just the lack of broader market liquidity we've seen in the past 2 years, there's just personal needs that employees have that don't always align with the timelines for their companies going public or being acquired or whatnot. We talked to a lot of employees who are looking to put a down payment on a house. They're looking to pay off a student loan. They're looking to buy an engagement ring, like one of our founders, our CEO, was looking to do, and really need the money that their equity, the sweat equity that they worked for, represents to be able to do that. And we found that when employees come to EquityZen and are able to sell, they really can feel that, hey, there actually is value to these shares. It's not just a theoretical number on paper, but this is something that I can use to kind of shape my future and make the life choices that I want to be able to, live the future I want to live. So we talked to a lot of employees about those types of things, and I think that need is just growing as the market grows.
Yeah, one thing I'd say too is for these employees, part of the job offer they got, or part of the everything that was promised to them or that they were told was going to be great was, okay, you're going to get this salary, of course, and you've got your benefits, but we're going to give you these stock options, right? And you kind of make this big grand gesture that you're going to get these options, you're going to be worth something in the future. And you're like, cool, that sounds great. I was going to go work at Google and it was way easier to understand the comp there, but this sounds pretty cool. And then you're there and 5 years pass by and your life continues to grow and you get to see this basically this like super illiquid nest egg that you have in equity at the company you work for. So you're like really concentrated at where you are. So yeah, it comes up a lot for sure.
So we talked a little bit about the employee perspective on this, but what are the types of conversations, Phil, that you're having with private companies? What are the problems they're trying to solve? What are the things that they like or dislike about this market? And, how do you speak to them about the value here?
Yeah. Well, I think the first thing to cover is that these are private tech companies, right? So their financials are not disclosed every quarter on a website or in your Robinhood account. So they are kind of private for a reason, right? One is that they have just a bit more control of their company. They don't have to give as many disclosures. They're still growing a lot. They're testing a lot of things out. But one of the reasons, some companies are really sensitive to these secondary transactions, right? When we started in 2013, the big pushback we'd hear was, the founder or the CEO or the CFO would say, well, we issued them stock and they're going to hold on to that until the company goes public. There's kind of like, you ride with us or you die with us, right? It's like, it's all in or it's nothing. And that was okay when a company was going to be like private for 4 or 5 years, but that number is more than doubled since then. So the time it takes for a company to go from founding to IPO is like something in the tune of like 12 or 13 years now. So companies have had a bit of an aversion to secondary liquidity because maybe somebody new invests and they don't know who they are. Maybe they have to deal with a lot of work involved. That's evolved over time too. So I think aligned incentives is a big one, right? You want people to have skin in the game, but you also want to be fair to employees and kind of reward them for what they've done. And you also want to bring tangible value to the very illiquid thing that they're holding on. And I think companies that have that aha moment are the ones that do think about liquidity a bit more kind of competitively, where they say, if I provide liquidity to my employees, they'll see that if they sold $100,000 worth of stock and that was only a tenth of their holdings, then they're actually sitting on something worth $1 million, where before maybe they kind of referred to it as some lottery ticket or some, that's like my, maybe money. Like the fact that you can actually give it value, I think is really, really powerful. So I think that's starting to perpetuate more and more, which is great. Still requires a ton of education. But every issuer is a little different. Every company, very different on this whole topic. But it is getting a lot more attention than it did, 10 or 11 years ago.
Yeah, I would say even in 2020, 2021, as we were talking to private companies, there were certain companies that were evangelists and on board and really supportive of this market and supportive of their shareholders' needs. As time has gone on, we've had more GCs and CFOs reach out to us proactively because they realize that there is a need for liquidity in the market, and they would rather be an active participant in that discussion than have their employees or ex-employees try to figure it out on their own and maybe sign off on a forward contract or some type of kind of derivative that's they're promising their shares to someone else, but the company hasn't actually approved it, and there's a lot of legal risk that could come from that down the line. And it also goes to the point about companies wanting to control who's on the cap table. If they're involved in these transactions, they can better understand who's buying and who's selling and have a seat at the table. So I think companies have, when we look at on a whole level, have chosen to get more involved in the market because they know these trades are going to happen probably one way or the other, and as much as they can be a part of that and control that, the better it is for them, especially as they have plans to raise capital or go public in the future. We've talked a little bit about how employees want to understand who's on the cap table, who their investors are, and have some control about that. Why does that matter? I mean, I think you probably have some insights both as a founder of a company, but also from the conversations you've had. So why is this something that companies care about?
Yeah. Well, probably the first thing to draw a distinction on is what it's like for a company when you buy a public share of stock, right? When you buy a share of IBM versus what happens if you buy a share of some giant technology company or a private tech company. So when you buy a share of IBM doesn't really know about it. IBM has basically an update from somebody that a share might have exchanged hands, but it's pretty much that one share can go to another. There's a lot of rules in place. We're all set, right? There isn't like somebody that gets notified at the end of the day that Lynch bought a share of IBM. Private companies, you can think of the private company as like the landlord of a building, and each of the units is being rented out. And they need to be notified if someone's going to move in, if someone's going to move out, what the price was, so that they're aware of what goes on, right? That's what you do if you're a landlord. And they want to know that the same way a landlord knows information about renters. Are they creditworthy? Are they going to ask me a bunch of questions? Are they going to pay on time? So a private company kind of has this whole list. It's called the cap table. And the cap table shows the list of all the people that own shares. And it gets updated when these things change. So new employee starts, or we raise money from a new venture capital investor, they come onto the cap table, right? And now you have this relationship with them. So you could imagine that if you ran a large building and you didn't have control of who was moving in and who was moving out, you'd be really frustrated. And so there's a lot of sensitivity on kind of who goes onto that cap table for private companies. And there's also like some regulatory things too, right? If you have like more than 2,000 people on your cap table, by most arguments, you probably have to be a public company and you have to file and register. So that's super sensitive, and also why one of the reasons Facebook went public. So there's a lot of sensitivities on the regulatory side, but really it's more like kind of keeping your home in order and knowing who lives there. I think that's the biggest piece.
I like that analogy.
It's just Monday, a lot of inspo going on right now. So Brie, we've got employees, ex-employees that want liquidity. You've got these companies that have maybe the same interests, the different interests of the employees about liquidity. How has EquityZen worked with the companies themselves to kind of address what you might call tension or camaraderie to kind of solve this problem? I'm sure it's a little different for each company, but would love to hear how it works.
Yeah, so we really try to take a consultative and partnership approach while we're working with all parties of these transactions. There are three parties: the buyer, the seller, and of course the company themselves. So we really try to take the needs of each into consideration, and can be a bit of a tricky balancing act, because if you only want to serve investors who are interested in investing, you probably don't really care what the company thinks, and you'll figure out a way to structure it so they can get access. If you are only focused on what the company wants, some companies maybe, don't want liquidity at all. You don't even broach the topic. And then there's no solution for both investors and shareholders in the market. So what we've really tried to do is create processes and just ways of running our business that meet the needs of all three of these players, a lot of times when these needs may be conflicting at times. And I think a core part of that has been having and building relationships with companies so that they know that we are a trusted counterpart in this market, that when we are buying, when our fund is buying shares, for example, that we are a passive shareholder who will be on the cap table, will not be, the tenant that is knocking on the door with issues, the ceiling's leaking, this, that, the other thing, every time something comes up, and that we're there to support them as they continue to grow. So kind of trying to balance that relationship with that of the shareholders and investors on our platform. And I think technology has helped us do that as well by making the whole process of these transactions more efficient for all the players that need to be involved. It takes a lot of burden off of the companies, and that also makes them, more willing to work with us, and happier to have us on their cap table and kind of supporting them on that journey, versus maybe others.
Yeah, one of the stats that I got from like the general counsels and the CFOs of private companies when we got started was that secondary transactions, like 90% of the work has to get done by the company itself rather than the marketplace or the platform that presented to them, which seems really odd. And so, we spent a lot of time since then thinking about what are all the steps involved to do this transaction, which is a little bespoke, a little different. What are the things we can do and take off their plate so that rather than this feeling like a burden, it actually feels like a solution. And I think over the last 10 years, we've hopefully kind of like inverted that, where we're doing 90% of the work and they're doing a little bit, so that they're really getting the main benefit, which is super happy employee, hopefully like a pretty nice investor in EquityZen or whoever that we bring to them. So yeah, it's definitely evolved over time.
Yeah, I think at the end of the day, a big goal that we have in doing these transactions is we understand that the GCs and CFOs of these companies have much more important strategic priorities to focus on than handling secondary transactions day in and day out. So how can we use our expertise and our knowledge in the market to make these more seamless for them, because that really benefits the entire ecosystem. To learn more about EquityZen and get started as an investor, visit EquityZen.com/investor and click Invest Now to start your pre-IPO investment journey.